that the BDA syllabus has applications, and that is the part 2 of the paper. And we also are all aware that, please, members, by the way, I want to remind you guys, I've realized that, most students forget about part A, and you give very little attention to part A of the BDA paper. Part A, which is theoretical, members, I want you not to forget to give it enough energy and time that it requires. It is a very, very important section because you have your 20 marks waiting for you there. And this tests you on the big data, the data analytics part, and also applications of Excel functions, and that is the theoretical part of it. So members, I want to reiterate and ask you, please, do not take it easy. Do not take it granted because it's a multiple choice part where you'll be required to just pick an answer out of the 4 choices. You have to have an idea so that you maximize on your scores. Do not look down upon this section. Please, when you have time, read the theory question, the theory notes, because you already have them. You already have them. If you don't have them at this point, then you need to find out and try to have them, because all the theory notes are all over. The most important thing is not having it stored in your computer. Make sure you make use of them. It will be very sad if you get to an exam room, you have a question, and because you did not get time to go through the theory notes, you don't have an idea, but you have them. After the exam, you try to open the notes and you realize all the answers were there. It will be very sad. So I want to ask you, with the time remaining, please create time for this part A, or the first part of the theory of the BDA paper. Then we are doing part B, which has most marks, because now the remaining 80 marks is coming from part B. And part B, those are applications of BDA. And I want us to look at the coverage, what we have covered and what we are supposed to cover remaining, especially on the first application of FR and FRA. So in this part, we have covered aspects, and we also have some few remaining that I would want us to iron out. One of them, 2 of them, we're already handling in this question that I've just shared. You know that we've done preparation of financial statements. And in the preparation of financial statements, you now should ask yourself and know that preparation of statement of profit or loss, statement of financial position, statement of cash flows, at least you have an idea. And analysis of financial statements using ratios is also another area under the FRA or the FR. And I hope that you are able to at least already you've covered something. And as we also continue doing it, make sure that you don't forget we have ratios in that section. We have common size financial statements. I don't know whether I need to put them down so that you make sure you remind yourself of the areas you need to look at. So under the preparation of financial statements, make sure that you know how to prepare the various financial statements. And the various financial statements that we're talking about is the statement of profit or loss. And I want to believe that members, you are all good at this section, preparation of financial statements. And this preparation of financial statements I've just talked about, P&L, profit. Normally, it should not even be P&L, it should be profit or loss. Then you also need to remind yourself statement of financial position, then statement of cash flows. I'm just writing them in short form. Profit or loss, statement of financial, statement of cash flows. When you talk about statement of cash flows, I believe you remember, you have the 2 parts. You know that you do for individual companies and also for groups. Make sure you remember that and the differences in those sections. We will still check through. In case you come across a question that is challenging, do not shy away. Share it across, get to clear out any doubt so that you be sure. Remember, these sections can always be set in any format. Examiners can set anything from the syllabus coverage. Then we have the analysis, analysis of financial statements. And whenever you talk about analysis of financial statements, you analyze them using various aspects. One of the ways in which you analyze is using ratios, of which this question here is already testing on ratios. And as we go through it, you also relate to other categories of ratios that are not covered, not brought in this question here. Then, as you talk about ratios, you also don't forget that we have something called common size financial statements. We are going to also do the common size financial statements and see how do you carry out the common size financial statements? How do you carry out trend analysis? Trend analysis. All this is within the syllabus. Examiners are free to set any of this. And when you talk about trend analysis, I want to combine the trend with cross-sectional analysis. Cross-sectional analysis. And remember, when you do all this analysis, you cannot run away from the dashboard preparation where we have graphs and charts. Graphs and charts. These ones will always be set, graphs and charts. So I want you to remember that all these are still falling under FR or AFRA. Then, after analysis of the financial statements, you also need to be aware that the syllabus also do the forecasting. Of course, the question that we also have here is asking you forecasting. Look at part A. They ask you to forecast for 5 years. Statement of profit or loss, this statement of financial position, then the cash flow. You do a forecast for 5-year period. Examiners love this section because it forms a basis of financial modeling and data analytics. Remember, the course is data analytics. So as you do the forecasting of the financial statements, which is also essential practically in budgeting, you are applying the concept of forecasting, which is within the coverage of the syllabus under FR or AFRA, the first application. So as you do forecasting of financial statements, you'll be given various assumptions. Like in this our case, they are giving us these assumptions, this information from 1 to number 13, and we use this information to come up with the forecast of these 3 statements. So you will be guided on how to do the forecasting in each and every question. Examiners will be free to set it in any way. Then we have sensitivity analysis. I had mentioned sensitivity analysis before, and I believe that you can relate. Sensitivity analysis is applying both, and not even both. It applies in the 3 application areas. It applies in AFRA or FR, it applies in FM part, and again, it applies in MA. Remember, all those are compulsory. Financial reporting, financial management, and management accounting. You will be required to do sensitivity analysis in all the 3 sections. So remember, the concepts, once you have the Excel concept on how to carry out sensitivity analysis using the tools provided in Excel, you'll be good. And this is tied to scenario analysis. Scenario analysis, which will apply on the forecast of the financial statements, the forecasted financial statements. Then finally, under this section, data visualization is always mandatory in all of them. It closes every section. So with this, you have to know how, that you've covered all the areas. Now, I want us to start straight away in this our question here. How do we start? Very first, I want us to look at the required. We are required to come up with a projection or the projected financial statements. And I want us to see how do we start here. We are required to prepare a statement of profit or loss for 5-year period. This is forecasting. We are modeling financial statements from the information given. So as we model, what year are we starting so that we do for the next 5 years? What is our start year? What is our starting year? How are we getting the starting year? I want somebody to tell us what is the starting year so that we model the statement for 5 years period. We are starting from which year, members? Victor is saying, what if I did not do AMA in the old syllabus? Victor, worry not, worry not. The AMA application in the BDA section is very easy. The AMA application once you have the basics, of course, we are still going to cover all the concepts that are tested in BDA. So this is simply an application part of it. The CVP analysis, the break-even point analysis, it's not difficult, Victor. It is very easy. And I promise you, do not even worry. Even if you did not do a MA, don't worry. These concepts we are covering under BDA is very easy. You just need to be keen and remind yourself of the simple concepts. Thank you, members. I see members there, Realme, Grace, Dorothy, and Victor. Dorothy is telling us there, and Alex, that the starting year is 2024. I believe all of us know how they got the 2024. I hope all of us can be able to see that, because it's important for you to know where are you starting to do the forecasting. You can see information number 2 is telling us the unit selling price is expected to be 18.5 in 2024. I hope and I believe that's where they picked the 2024 from. You are not told when the question started, but it is here. So this is a hint. You need to always know which year to start, then which year to end, given the period. We have a 5-year period. So I'm just going to divide my page into 2. So let me first move this a bit here. Then I want to divide my page into 2 like that. Then I start doing my model. My model, we've already known where to start, and we are starting from the year 2024, which is the starting year. And if you move from 2024 for the next 5 years, so 2024, we go all the way to 2020. These are 5 years. These are 5 years. From 24 to 28, those are 5 years, because 2024 is included. So that is the basis. Once we know the range of years, then we start modeling the statements. So how do we start? We'll be guided. We start from information given in part 1. The company is expected to produce 1 million units annually. Now, that is the starting point. So we will be reading each of this information and building up or modeling the statements step by step. And members, I want us to see, because this is testing us on forecasting, modeling, and analysis of the financial statements. And you know, analysis talks about the ratios and these other, the ratios. And in fact, in this case, the examiner has been so kind by even telling you about which profitability ratios to use, which liquidity ratios to use. But you need to know, even if you're not given this other breakdown, you need to know what are profitability ratios and what are liquidity ratios and what do they test. Interpretation of the statements. These are practical paper. You need to always remind yourself. Now let's start. We are being told that the company is expected. Remember, the reason why they're using the language expected is you are told that you are the chief investment manager and you are supposed to model a financial statement for a new startup. So remember, this company is a new startup. So you are just doing something like a budget. You are forecasting a statement. You are modeling a statement. So that's why they're using the language of the company is expected. So the company is expected, and the first thing is units. What is the production expectation? It is expected to produce 1 million units every year. So in 2024, it is expected to produce 1 million. If it is every year, then all the 5 years, the rate of, the units that is expected to be produced will be the same. That is 1 million across, like that. That is the first step. The next, we are reading information number 2. The unit selling price is expected to be 18.5 in 2024. So I'm just following what the examiner is saying. And it is telling us, the examiner is telling us about the unit selling price. Unit selling price. I've not written the word unit because already we have units up here. So to get the total price, you just multiply the number of units times the selling price. So selling price in 2024, they're saying it is 18.5. It is here in note 2. In note 2. That's where I've picked the figure from. Then I just go to note 3 because that is all about note 2. So what is note 3 telling us? Note 3 is saying the unit selling price is expected to increase by 5% annually. Very easy, very simple. And when you talk about the selling price increasing, there are always two approaches, and you're free to use any of them that you're comfortable with. What do I mean? I want to give you both, and you decide which one is easier for you. We have the selling price for 2024. We are told now, you see this selling price of 18.5, it is expected to increase by 5% every year. Now, increasing by 5%, somebody will decide to add the 5% to 100% to make it 105%. Then you subject the previous year's selling price to the 1.05% to get the figure for 25, to get the figure for 26, like that. Another individual will use the bracket approach, where someone will say equal to 1 plus the percentage increase, then you multiply by the previous year's selling price. So I want to give you both the two approaches. I want to start with the bracket approach first. To do the bracket approach, I want to use this column, this column here at the end, to do my percentage changes, And I want to put there the 5%, like that. The reason why I'm using the 5% is because the concept being tested here is also referencing. We can also remind ourselves of referencing. So to get the selling price for 2025, I will put an equal sign. Then open my bracket and say 1 plus. That 1 that I've typed in there represents 100%. 1 plus, just a second. I don't know, somebody's calling me or something. Okay, all right. I think that's a notification. Okay, so that 1% that I've written there represents 100%. So 1 plus. I want to grow this figure in 2024 by 5%. So what do? I will refer to the 5%. The reason why I typed it in there is because I wanted to do referencing. I wanted to do absolute referencing by fully locking it, because the rate is going to remain constant per year for the next 4 years from 2024. So what do? I will fully lock that cell by using F4 or function F4 key, whichever works in your case. So I click on F4 and you see it has introduced dollar signs in all the reference, a column in row. Once it locks it, I will close my bracket, then I multiply that by the selling price in 2024. So I believe you know why I'm locking, and it is growing every year. So that one will give me, so if I click on Control Enter, I'm getting my selling price in 2025 as 19.425. Now, I will comfortably autofill by either double clicking or just I drag across to 2028, and I have my projection of the selling prices. And because I see differences in the number of decimal places, I can decide to make it uniform by doing what? By saying I want it to appear in 2 decimal places like that. And those are the selling prices. That is approach 1, which of course is very easy once you type it in here. If you don't want to type the 5% at the end, you can simply type here 5%, manually put in 5% so that that 5% remains constant. The reason why this approach is easy is because when doing sensitivity analysis, you might be told that there is a change. Maybe if it was 5%, then it changes to 10%. If I go this way, I just have to change this one, the 5% to 10 or to 7 or to any percentage, and it will reflect in all my figures here. So this one becomes very easy in that approach. I hope members, you are relating to the sensitivity analysis I'm talking about. All right, then the other approach is I said there are people who will want to add the 5% to 100%, which is still accepted. It is still accepted. So Liaka is saying, I repeat, it's all right. So what I've just done is very simple. I'm using still note number 3, where they said the selling price is expected to increase by 5% annually. So 5% annually means the selling price in 2024 is increasing by 5% to give us selling price in 2025. Again, whatever you have now in 2025 as the selling price is again increasing by another 5% to give you the selling price in 2026. Again, the one in 2026 will also grow by the same 5% to give you the new selling price in 2027. That's what they mean by growing by 5% or increasing by 5% annually. Now, what I've done, I've used the bracket approach where I will activate this my formula so that you see. I've typed in 5% in the end. And I've used the bracket approach by opening a bracket and I say 1 plus. This 1 represents 100%. I'm simply adding 5% to 100% using this Excel provision, and I've referred to the 5% and fully locked it. The reason why I've fully locked it is because that 5% is constant. What do you think will happen if I don't lock it? Of course, I can remove the locking so that you see the effect. I can refer to the 5% increase, then I multiply by the one in 2024 to get my price in 2025 and I get an answer, which is correct. So this is correct. But I will not be able to autofill the rest correctly because I have not locked. So you can even try and see. If I drag to get my projections up to 2028, you'll see the figures are now changing. And what do you see there? You will see that my selling price will be constant for the next 4 years. Why do you think so? It's because now Excel will move from cell where there is 5% to the next empty cell. So I'm not changing the figure or the selling price in 2025. It will still remain the same because this blank space is equivalent to 0. I'm growing it with 0%, so it remains the same. That's why you're able to see all these are the same figures. So that is not correct. That's why even if you go to the one in 2028, it will refer to this empty cell which is here. So to avoid this one here, you really need to tell Excel that this my 5% is constant. That's why we said you fully lock the reference. You do absolute referencing to this cell J4. So what do? I said use F4 or function F4 key. And once I do that, if I autofill, that cell will remain constant in all these computations. I hope somebody has gotten that. That is the first approach. In the second approach there, I said you can opt to add it manually. So what do I mean? I will come here and say, now if I add 5% to 100%, it is 105%. If you divide 105% with 100, it will be 1.05. So what do? I will just subject this selling price in 2024 and multiply it by, because I'm growing it by 5%, I will multiply by 1.05. And what do I get? I will get the same figure as the one I got here. So in that provision, I also do the same for 2026 by doing the same. I will subject this selling price in 2025 to, I just multiply by 1.05 like that. I will get my selling price in 2026. So that is the manual way, by just multiplying directly. If I do the same here, I will multiply the selling price now in 2026 by 1.05. And you can see our figures will be the same across the board. If you put it to 2 decimal places, you realize that we are simply the same figure. So the approach, you can adopt any, but make sure you take the easy one that you understand best and that which will not confuse you. All right, so that is it. We go to information number 4. We go to information number 4. All right, so Liaka is good, and I hope everyone else, we are on the same boat. Right. Number 4, we are told the cost of goods sold, in bracket, percentage of revenue, will be 42%. Members, what are we building up? Which information, which financial information are we modeling? I will ask you to refer to the required. We are told to prepare this financial statement of profit or loss. Now, you know very well that cost of goods sold is a component of the statement of profit or loss. So why don't we just start straight away to build that statement? Why don't we just start and say, let us answer Roman 1 straight away. So we are modeling the statement of statement of profit or loss. And what I want to do is just write the title here by saying statement of profit or loss, like that. We start modeling it straight away without wasting time. So what do? We know the format. Members, we know the format. It is the same one that you've been doing all along, from financial accounting, financial reporting, advanced financial reporting. So it is the same format you've been using, nothing different. The only thing is we are now doing financial modeling. So what do? We know the format. We know very well that when preparing your statement of profit or loss, you normally start from revenue. Nobody really has to tell you from these statements. Remember, we've read statement 1 up to number 3. Now we are in statement number 4. They've not mentioned anything to do with revenue. But do you know why the examiner has not done that? Because the examiner expects you that at this level, you already know that once you are modeling a statement of profit or loss, you know that in its format, you must start with revenue. And how do you come up with revenue? When you have the information of units to be sold, and you also have information about the selling prices expected, then of course, at the back of it, that already gives you how to get your revenue. Members, I hope we are understanding each other. So they don't have to mention the word revenue or sales, because what they've given is enough to build that. So I would want to borrow the same lines of the years. So to use the same lines of the years, I just want to write this revenue from the first column here, so that this one here is for 2024, 2025, 26. I don't want to repeat typing the years here. We maintain the columns to represent each year. So I believe we are together. So for year number 2024, we already have the units, we have the selling price. How do we get revenue? That is very easy. We just multiply the number of units expected. I'm using the word expected because we are modeling financial information for a new startup. They just want to do evaluation. They just want to see what projection, what are we expecting the information to look like. So we are building that information. Multiply the number of units expected in 2024 by the selling price for that year. And that gives us revenue for 2024. Now, I've done reference to these two cells. And because I want to make my work easy, I will not keep referring to the cells when I come to 25, to 26, 27, and 28. Because they are well aligned and there is no empty space in between the columns and the rows. Why don't I just drag my formula to the end like that? And I should be having all my figures auto-populated. And I just check, does it refer to the correct cells? The answer is yes. Does it refer to the correct cells? We agree that's okay. And again, for 2028, it is the same. That is the beauty of doing reference. Cell referencing is very, very important. Once there is no empty row or empty column, you just autofill like that. So revenue is done, and I hope we are together. We go to the next bit. And the next bit is where we were reading in note 4. In note 4, the examiner is telling us that the cost of goods sold is a percentage of revenue. And it is at what rate? 42%. 42%. So with that information, members, what do? We just follow what the examiner is telling us. Very simple. The examiner is already guiding us. We know after revenue in our format of the statement of profit or loss, we take off the cost of sales. And because we are taking off the cost of sales, I just want to start by an equal sign, then I introduce a negative. I believe somebody understands why I'm introducing a negative, because cost of sales is an expense. We are deducting it from revenue so that we get gross profit. And we are told that that cost of sales, we should apply it as a percentage of how much? 42%. So what do? I type 42% of revenue, which already we've computed up here. So I refer to the revenue in 2024. Members, I hope we are together. Then I just confirm by hitting on my Control Enter. And I have my cost of sales for 2024. I can see it is coming in bold, but I don't want it to be in bold. So let me just highlight that region and remove the bold part. You can remove it by Control B, or you just go and hit on that bold button, which is there under your home tab up there. All right. So once I've done that for the first one, this percentage is not going to change. If in case you are doing sensitivity analysis, in fact, there is a very good question which we need to get about sensitivity analysis, just to remind ourselves on the changes of the percentages, so that you get to know how sensitivity analysis will come in and affect your statements. So in case we were doing sensitivity analysis, you know what we could have done? You see this column where I wrote the 5%, someone would opt to bring the 42% here. You bring the 42% here, like that. Then once you bring 42% here, you're bringing it there because in sensitivity analysis, you are told that, you expect the percentage changes to, to change from one scenario to another scenario in scenario management. So in that case, you will be required to come here and say it is 42% on the revenue. So you refer to the 42%, and because this rate is constant here, you'll be required to fully lock it. Then you multiply by your revenue, and you get your figure. You get your figure, 42% of the revenue. So I refer to that, then I multiply by 42%, which of course is constant. You get your cost of sales. And now this format is helping in sensitivity in a way that if you are told that in another scenario, maybe in a worst case scenario, the cost of sales will go up. Yes, in a best case scenario, the cost of sales, the percentage of the cost of sales will go down. So we given those three scenarios where there is worst case scenario, best case scenario, and any other scenario. And this percentage change will always differ. In that case, this format is very recommended, so that when you copy this information and you paste it, or maybe you want to change it to another scenario, you realize you only need to change the percentage. You don't have to check anything here because you refer to that cell. That's why this format, it's very recommended when doing sensitivity. But for now, I think it is not a must because we are not doing sensitivity. So, but it's good to know how to apply it. Now, once I do that, because I typed in my 42%, that figure remains constant. And I referred to this cell. When I drag, Excel will move and proceed with me from one cell to the next. And make sure to apply this, make sure there is you don't have any merged cells, you don't have any empty space, either in the column or in the rows. So that when I autofill like this, it picks the correct figures across the board. So members, I hope we are together like that. All right, we go to note number 4. We go to note number 4. Note number 4 is, in fact, we are done with note 4. We go to note 5. And what does the note 5 say? Note 5 is telling us that the salaries and benefits expense is a percentage of revenue, and it is coming at 17.0%. So members, we are modeling statement of profit or loss. We already have our cost of sales. If we deduct it from the format that we already know, we know that this gives us the gross profit, which is the net effect of the two. And because I've used a negative here, I just use the auto sum. My alt equals, I get the auto sum there to give me the gross profit. And with that, I just autofill to get all my gross profits across the board. I hope we are together. Because it's an element of profit, allow me to use Control B to bolden it. You can use Control B, or of course you can just highlight. Then you come here and hit on this B. You still get the same results. All right. We are told something about note 5, mentioning salaries and benefits expense. These are expenses. And you know that after getting your gross profit, in the statement of profit or loss, you normally go to expenses. I know somebody is wondering, we were preparing published accounts and we were not putting those expenses as line items. That is correct. I agree with you. So someone do not expect us to write salaries and benefits. I know someone is not expecting us to do that. Someone is expecting admin expenses, selling and distribution. That person is correct. But here, when doing modeling, we are not preparing published accounts. We go with what the examiner is telling us. So what is the examiner telling us? That these expenses, one of them is salaries and benefits. So what do? I simply follow what the examiner is saying, salaries and benefits. Salaries and benefits expense. Yes, that's what we are doing there. Then salaries and benefits expense, we are being told by the same examiner that it is a percentage of revenue. At what rate? At 17%. So what do? We simply follow what the examiner is saying. Again, I reiterate by saying you can opt to use the same column. You type the 17%, then you refer to that cell and you lock it fully and you subject that percentage to the revenues and you get your expenses for that line. In sensitivity analysis, it is very recommended to do that. But for now, I don't think we will need to change any of these percentages. So I will simply just use the same cell. I will type it in manually. What am I typing in? 17%. But because it's an expense, allow me to put a negative. Then is when I type my 17%. Then I multiply by, I refer to the cell of revenue because the examiner said that it is a percentage of what? Revenue. That's why I'm referring to the revenue cell. I hit on Control Enter and I'm getting my salaries and benefits expense for year 2024. Because I've typed in my 17% manually, it will remain constant even if I drag. If I could have written or typed my 17% in another cell and referred to it, I would be required to fully lock it. But because I typed it in, it is not going to change. And I referred to this cell. Make sure when you refer to the revenue cell, do not lock. Why? Because we are going to drag it. We don't want to repeat ourselves by typing in the same thing for each year. That is wasting time. So with that, in that that cell in 2024, we just drag and autofill to the end. And of course, we can confirm that actually it has picked the revenue for each year the correct way. Members, I hope I'm not alone. Confirm to me that I'm not alone. Confirm to me we are together. As we move to note number 6, are we together? Are we together, members? As we move to note number 6, are we together? I just want to know we are together. I just want to know we are together. All right, we are together. So we proceed. We go to note number 6. We go to note number 6. Thank you. All right, we are told again in note 6 that the annual rent and overhead expense are 500,000 and there is a full stop. The examiner is not telling us if it is increasing, decreasing, or if it is a percentage of anything. The examiner is simply giving us a figure of how much? 500. And again, the same examiner has not told us whether it is annual or it is applying to a specific year. So because of that, we cannot, assume that the 500 is only applying to 2024. We will assume because we are dealing with a range of years, we are projecting and building up modeling this statement for 5 years. This annual rent and overhead expense of 500 is across the board, across the years from year 1 to year number 5. So I will type in rent and overhead expense and we are told it is 500,000. So I will also bring it in as a negative because it's an expense. So I'm typing 500,000 for year 2024. The same 500,000 will run across to the last year. And I put a comma style there, and there you go. Then after that, we go to the next note number 7 or information number 7 to see what we are supposed to do. We are told something about depreciation and amortization, which of course is a percentage of PPE, property, plant and equipment, and it is at 25%. It is at what? 25%. So if it is a percentage of PPE at 25%, members, do we already have PPE? The answer is no. So what do? We are supposed to do our PPE movement schedule. Our PPE movement schedule. But because we are talking about depreciation and amortization, these two expenses given here, they will represent our expenses in the categories we are used to: the admin, the selling and distribution, other expenses. Now, that will give us some profit called earnings or profit before interest, tax, and depreciation. Because we know that amortization and depreciation normally those are elements of the PPE and also any intangible assets. So there is a profit element here. I want to call it earnings before interest, tax, depreciation. You can even also add amortization, but once I put depreciation there, let's assume it will represent that reduction again in that other category. So that is the net effect. I want to use alt equals, and whenever you use alt equals, it's a summation tool. It helps you to do the auto sum easily, but you have to tell Excel the range of auto sum you're working with. Now you see, I've just typed in my alt equals, and you see it is highlighting the two expenses. But I want to get the net effect from gross profit. So what do? I have to re-advise Excel by highlighting what I want. So do not always just type alt equals and then you type enter like that. Make sure you confirm the range you are working with. If I wanted it to cover from revenue, I would highlight everything like that. You see, it is not even refusing. So you have to guide it. Make sure you guide it correctly. If you don't guide it well, you'll get a wrong answer and you'll start blaming Excel. That, oh, I used alt equals and why am I getting a wrong answer? These examiners are very mean. They are not mean. You didn't take your time to check on this. So I want to say that Excel, please get me auto sum from this part. I'm getting my earnings before interest, tax, depreciation for 2024. The same formula I drag to 2028 like that. And I have that profit element already auto-populated like that. So let me put it in bold because it's a profit element. Using Control B, I said you can still come and click on that B there. You should get the same output. No difference. All right. All right. So we go to the next bit. Now, I said, examiner told us something about depreciation and amortization, and it's a percentage of PPE. Members, we don't have PPE yet. We have to build it. We have to build it. How do we build our PPE? How do we build our PPE? We need to get that information. But before we get it, I want us to look at what we are given. Information touching on PPE, do we have any? Aha. We are in note 7. Note 8 is about interest rate, that is interest expense or finance cost. Number 9 is about tax. Number 10 is about accounts receivable. 11 inventory. 12 payable in days. All right, I see note 13. Note 13, yes. Wilkista, next time do not blame Excel. The problem is not Excel, it is you that you are not very careful. All right, I see Elodoro and Jaydan is telling us that we have note 13, which has something for us on PPE. I agree. So note 13 is saying capital expenditures in year 0. This word percentage is really disturbing my head why the percentage was written there, yet we are given a figure. So if I don't know what it meant there, but for now, I will just pick my 15 million. And we are being told how it will be funded by a debt of 5 million and equity of 10 million. So okay, Wilkista is saying yours has no percentage. So where did my percentage come from? Hey, is it the ancestors who don't want me to get to see the correct thing? What's happening here? But it's okay. It's okay. That word percentage has no effect. Salaries, somebody, Dama is saying that she got salary of 182, 182 for 100. Dama, is that the same salaries that I have? Salaries. I'm wondering why you got that figure, which is different from what we have, but kindly just confirm that you've used the correct percentage, which is 17, and also confirm that you referred to revenue. Do not refer to any other figure. Make sure you referred to revenue. Make sure you referred to revenue to be able to get the same figure as ours, or what is showing on my screen. Once you do that, you should be getting the same, unless your revenue figure is also different. Make sure you check across the cells if you have the same figures as what is displaying. You will be good. Winnie is asking, these abbreviations, can I use them in exam? Cost of sales, earnings before interest tax. Oops, sorry. So Winnie, really, there is no problem. You will not be penalized when you use the COS as cost of sales. Remember, this is a professional level examination, and the examiners who mark these papers, they are not picked from anywhere else. These examiners, they are also professionals in the field, and they understand when we use COS to represent cost of sales. But if you have the time, you can type the full word cost of sales. I know it's recommended to type the full word cost of sales, but in this case, if you use this EBITD, this one, you don't have to type it in full because it's a long word and it is obvious what you are writing here, what you're typing here. So no one will penalize. You'll get full marks if you use COS to represent cost of sales, because examiners who mark these things, they're professionals in the same field. So you will not be penalized. There are some of them which are obvious, and there are some of the abbreviations that are normally just brought up, by teachers to shorten the words. So those ones which are not standard, you have to type it in full. But the standard ones, make sure even if you use them, you don't worry. No one will penalize you. I hope that's okay. So note 13 is what I want us to use, the capital expenditure. We know that when doing the cash flows, you know that the capital expenditure touches on investing activities, where these are huge capital investments that touches on the PPE elements. So that is where we call them a capital expenditure. Capital means huge capital outlay, and it is on the PPE. Now, I want us to do something here about the PPE so that we see what is the movement in the PPE, what is the changes in the capital expenditure, so that we get to compute the depreciation on that capital expenditure, depreciation on the cost of the PPE. We apply the depreciation. We see the net book value, the cost, and all that. So let's do it down here. I don't know how much space I need to leave, but I'm just estimating. Let me just put it somewhere here. So I want us to do something on PPE using that note 13, and I want us to be keen and see how are we going to do it. Now, we are projecting the statements from the same years 24 to 28. So I can still go ahead and copy it. Now that I've skipped a lot of cells, the alignment might confuse us a bit. So let me just bring the years from 24 to 28. Now, this capital expenditure, we look at note 13 and read it again. We are being told that capital expenditures in year 0 is 15 million. Year 0 is 15 million. So if year 0 is 15 million, our year 0 is 2024. That is where we are starting. It's 2024. So this, I want to call it balance brought down, because that is where we are starting. So balance brought down, it is 15 million, like that. So if we have 15 million in 2024, and we are being told, is there any other information added? They just go ahead and went ahead and told us about how it is being funded, by debt and by equity. So if that is the information that we have, then I want us to see, do we have depreciation figure for the first year, 2024? Because we know that when dealing with PPE, whatever net book value that is closing in 2024 is what will open 2025. And I believe that that is something we normally understand, the movement, the effect of depreciation on the net book values. So how do we pick the depreciation? We were told in note number 7, what is it, note 7? Yes, note 7, we were told that depreciation and amortization is a percentage of PPE, and it is at 25%. Now that we already have PPE for 2024, we can go ahead and now compute our depreciation for that year. I hope we are together, members. We can now go ahead and compute our depreciation for that year at 25% and say that if we subject it to depreciation charge for the year, we will subject it at, was it 25%? Let me just confirm again. Yes, it is 25%. It is in note 7 for someone who might not have seen it. It is in note 7, 25% to get the value of depreciation and amortization. So my 25%, I will subject it to the balance or to the value of PPE in 2024. That will give us depreciation. And because it will reduce the value of PPE, I would want to bring it as a negative like that because it reduces this value of PPE. I will bring it in as a negative like that. So this will give me what? This will give me the net book value. I hope, members, you can relate. Somebody can use the T accounts, but all along, you remember, have been discouraging T accounts because now, like we are modeling this statement, how long do you think you might take to use T accounts for each year? It will be a lot of time. It is correct, you might get still the correct figures, but you can imagine the amount of time you need. That's why T accounts may not be very good for exam purposes. Understand the concept behind it, then apply everything in one cell. Now, the net effect of depreciation, I'm using alt equals, and you can see whenever I use alt equals, it will assume the range. But I'm not starting from 2024. I have to re-instruct it and say, please, I want the net effect of only these two. And I'm getting my figure, net book value for 2024. Now, members, we are aware that the net book value closing a year is what opens the following year as the balance brought down. So in that case, we can go ahead and get our balance brought down for 2025. Remember, if we had any accumulated depreciation, if we had any brought forward of accumulated depreciation, it would affect the net book value closing 2024. I hope, members, we are understanding that. If we have any accumulated depreciation, it would affect this. I'm assuming that in note number 7, they told us that the accumulated depreciation, but because this is a new startup, of course, it does not have any accumulated depreciation. It does not have. It is when we are starting from year 0, we are building this statement. And remember, accumulated depreciation is simply depreciation from previous years. Now, you need to know, as we move from 24 to 25, there is already depreciation in 2024. When you are getting depreciation in 2025, remember, you don't only charge depreciation for that year 2025. You must also bring on board the accumulated depreciation aspect because the depreciation that was in 2024 will also affect the value of that PPE so that the value closing the year 2025 takes care of any accumulated depreciation to that date. When you do for 2026, it must also consider the depreciations for the previous 2 years because it is affecting. Depreciation constantly reduces the value of PPE. The same way, when you reach 2028, the total depreciation that you are effecting on the cost here should be considering all the depreciations for the first 4 years because it will eventually have an impact on the closing value of PPE in 2028. Members, I hope we are getting that concept. I just want to hope. So that tells us that we have to introduce the element of starting to accumulate because we have to start accumulating it here because it will eventually affect all these costs across. We don't charge only the depreciation for the year. No. We must make sure we consider all those past years' depreciations as we move forward. So let us start accumulating. How do we start accumulating? I want to write here accumulated depreciation. I just want to put it like that. Sorry. So the accumulated depreciation for the first year is the same as the depreciation charge for that very year. So This is not different. So I'm just referring to it. That is not different. And when you do that, you know very well that when you add net book value, to accumulated depreciation, you are going back to the cost. I hope no one is getting confused there. How do you get the net book value? By deducting accumulated depreciation from the cost. So meaning, if you add accumulated depreciation to the net book value, you are simply reversing the process and going back to the cost, because you normally deduct accumulated depreciation from the cost to get the net book value. So the opposite is the same. If I add accumulated depreciation to the net book value, what am I getting? I'm going to get my cost back, 15 million. I hope you're getting it. So if I want to know the cost of PPE at the end of each and every year, I will come here and say the cost of PPE by adding net book value to accumulated depreciation. It will give me the cost. But now that accumulated depreciation is coming here as a negative because it has a reducing impact on the value, what do? I will now play with the signs, the positive and the negatives. To add these two, I will come here and say, let me just say, I will add the net book value, and I'm adding the accumulated depreciation. So if I want to bring this negative to addition, I just introduce another negative. A negative and a negative will be positive. And I refer to that cell. I will be adding in essence. And that will give me the cost of PPE for the first year. The reason why I'm coming up with the cost, it is the same as what we started with. It is actually the cost. But I'm laying ground for these other years. You will see how it plays out very beautifully. When we talk about capital expenditure, we are checking on the changes in the cost. How much did we spend in each year? Yes.
Umepataje accumulated depreciation?
Accumulated depreciation simply means depreciation that has accumulated over the years when the asset has been in use. Now that we are just starting the first year, what I've just done is to refer to the depreciation for that first year. We don't have any other previous depreciations. That's why I've just referred to it. But you're going to see it clearly when we come to 2025, 2026 as we move. You're going to see how it plays out because it will not be the same. It will keep changing. I'm just referring to this because it is for the first year. We don't have any other depreciation that has been brought forward. We are just starting now. So I've just referred to it like that. But let's move to 2025 and you see what now we will bring here as our accumulated depreciation. I hope we are together. All right. So
excuse me, sir.
Yes.
How do you realize that you're supposed to use the accumulated depreciation instead of just the depreciations?
Okay. Members, I want you to relate to the published accounts that we've been doing before. Normally, the examiner normally gives us trial balance. Somebody is enjoying bread somewhere. So let me take care of it. Okay, all right. So we normally have trial balance. I just want to make somebody understand what I'm doing. I can even highlight this area in yellow so that you see it is a different thing. Now, we normally have a trial balance. And this trial balance, you are normally given the PPE elements, but I want to break them down. Maybe you have building, and the value of the building, you are normally given the value of building. Let's assume the same 5 million there. Then you are told that accumulated depreciation for building, the examiner normally gives you the accumulated depreciation for building. Let's assume that you are told that the accumulated depreciation for building is, let's say, 30,000, like that. That is the accumulated depreciation. Then, under additional information, remember this is a trial balance. This is just a trial balance. Under additional information, the examiner tells you that depreciation on the building or on PPE, depreciation on PPE is, for example, charged at 10%. So you are told depreciation at 10%, reducing balance. Reducing balance. Remember, we have two methods of depreciation, either straight line or reducing balance. So you are told, for example, depreciation is 10% on PPE, on the building now. So in this case, how do you compare? Remember, this is published accounts, and you will be required to prepare statement of profit or loss, and because you are preparing published accounts, someone will tell you how to classify that profit or loss. So in the additional information, you'll be told that depreciation is that percentage reducing balance to be charged, for example, in admin expense, like that. Because it is published accounts, you cannot put the line items of expenses under it. Now, in this case, you are told to charge it under admin. So in preparation of your profit or loss, under your admin expenses, you must make sure that depreciation is part of that value, right? So, and again, you'll prepare your statement of financial position at the end of the day. And in your statement of financial position, you will have your PPE, and this building will be part of the PPE. Yes, so we can even change the building to read PPE, but it is still the same thing. I'm just using building as an example of PPE. Now, in your statement of financial position, you remember you will have to put your closing net book value, because PPE, you are putting there the value at the end of the year. So you need a figure here. So remember, with this information, you need to get a figure of depreciation and you classify it under admin. You need to get a figure of the PPE, and this information will still help you. So what do? To get the depreciation charge for the year to put under profit or loss, you will come here and say, remember, it is reducing balance. You'll come here and say it is 10% of, you open a bracket, refer to the cost of the PPE element, then you deduct the total accumulated depreciation. Remember, we are charging as a reducing balance. So the total depreciation that has been accumulated over the years of usage of the asset has eventually reduced the cost. So we deduct it from the cost to get the reduced balance, which now we are subjecting 10% to it, to get the depreciation that we are charging today. We are charging today in this current year. Now, you will get a figure. I'm getting 49,000, 497,000. Yes? Did I multiply that 10% of that difference? That's okay. That's okay. 10% multiplied by cell G42 minus G43, like that. So that is giving us the depreciation charge for the year. You know what I'm wondering? I'm wondering why it is 497,000. Let me see. What if I get the difference between the two in a separate cell? It is the same. What? Okay, it's all right. This was 5 million. It's okay. The figure is correct. It was 5 million. I was wondering why my mind was telling me this is 500,000. This is 5 million. So this is correct. Now, this is the depreciation per annum. This is the depreciation charge for the year. Depreciation charge for the year. For the year now. Depreciation charge for the year. If this is the depreciation charge for the year, I will go to my profit and loss. Because I'm classifying it under admin, I will take the figure of the admin. I'm assuming admin, I was given a figure, for example, 200,000. And then I will add my depreciation because I was told to classify it under that. So I will add this cell here. I will add this here. So I will put an equal sign. Then I add this. I will get my total admin expense. Now, profit or loss, I'm done. Now, I want you to see now the impact it will have on PPE. For the person who was asking, now this is the point you need to ask. You need to understand. Now, when you come to the PPE, in the statement of financial position published, your intention is to get the closing net book value. And I want to do all of them in one cell. You can go for the T accounts, but I discourage it. It will consume your time. So you come here and I put an equal sign. Now, my PPE element in the trial balance is building only. Now, I know that the opening cost was 5 million. Now, from this cost, there is that depreciation that has accumulated over the years. The asset has been in use over the years. And it has reduced in value. By how much? I was told to the date of the preparation of the trial balance, it had reduced up to by 30,000. So I have to knock off the 30,000 like that. Then I'll also charge the current year's depreciation, meaning what? This asset has also reduced further in value by the end of this current year. So I will still go ahead and reduce it by the same depreciation charge for this year. So my closing net book value of this PPE or of this asset now will come to this value. This is what I'm taking to the statement of financial position. Now, what have I done here? What have I done here? Are you seeing the impact of the depreciation charge for the year on the accumulated depreciation? Now, if I'm moving from this year to the next year, my total accumulated depreciation will now be the accumulated depreciation from the previous years plus what I've charged for the current year. This is the total amount by which the asset has lost value. I'm adding the depreciation charge for the year to the accumulated depreciation. Meaning by the end of this year, my figure for accumulated depreciation shall have gone up to this 527,000. It was 30,000 by the start of the year, but I have to include the depreciation that I'm charging for this year. So when you are moving to the next year, the reason why I'm talking about moving to the next year, I'm bringing in the aspect of this forecasting that we are doing. Remember, this depreciation, this is the charge for the year, and it is the same accumulated because we don't have any other previous figure. Like in this case, we had 30. If there was no accumulated depreciation, then the same depreciation for the year would be the same as the accumulated for this year. But when we move to 2025, I want us to see 2025 here, and we relate to this concept, and we will be good. Now, we are moving to 2025. I just want you to hold on to that your thought, because you are going to see it. In fact, that question you have is going to be answered when we do this 2025 together. Now, let's do it. When we come to 2025, the opening book value for 2025 is the closing book value for 2024. And I'm talking about book value. I'm not talking about cost. I want you to be very careful. I'm talking about book value. I'm not talking about cost. Because this is what has closed the year one. We are moving to year two. The book value opening year two is the book value that closed year one, which is how much? 11,250. I'm referring to it. I've not referred to cost because the asset, we are recording assets in the books at their book values, not at their cost. Remember that. We prepare our statement of financial position at book value, not at cost, because this asset has been losing value over time and it is still losing value over time. That's why I'm picking on the net book value. Now, I will put that as the opening value. Then the depreciation charge for the year 2025 now. Remember, we're in a new year. The examiner told us in note number 7 that depreciation is at 25% and it is on the value of PPE. So what is the value of PPE for starting 2025? It is this 11,250. So what do? I'm going to charge my 25%. I'm putting a negative because it reduces the value. That's why I'm putting negative. And I'm just typing 25% of what? Of the value that has opened the year. Now, you see this 28,12,500. This is the same as depreciation charge for the year. You see here, I computed depreciation charge for the year. It is the same. Now, in my computation using the reducing balance method, I deducted the accumulated depreciation up to that year. That's what I did here. The 30,000 I deducted before I subjected to 10%. Now, I want you to relate that concept. Now, we are coming here. What is the closing net book value? And this is, yes?
Now, kindly, I'm sorry, I lost my net. How did you get this 5 million of building and the depreciation of 30,000, please?
I did not get them from here. This was just an example that I was using to explain how to compute depreciation here and the impact it will have on the value of PPE. So this was just an example. I just came up with this. It is not part of our question. That's why I even highlighted it.
Oh,
This was just for
okay.
explanation. Yes. So I'm just leaving it here. I just want us to relate to what I was doing to see how this one moves. You
Okay, thank you.
understand? All right.
Yes.
So we are coming to this part, and I want you to be very careful. Remember, we're in a new year. We're in a new year. And we are looking at the capital expenditure. Capital expenditure is the difference or the movement in the cost. Capital expenditure touches on cost. And when it touches on cost, we want to see what is the cost of the asset in 2024, 25, 26, so that we see, was there any capital expenditure? How much did they spend to buy or to purchase PPE as we move forward? That's why I brought the element of cost here. And I'm just working in reverse because we know we get the cost. When you deduct depreciation plus accumulated depreciation, we normally get the net book value. And when you add now the total accumulated depreciation to the net book value, you get the cost. That is, it is just the reverse. Now, as we move here, I want us to get what is the net book value without still touching on the accumulated depreciation. In this my example here, I said this is the closing net book value. Closing net book value. And my closing net book value took care of the depreciation charge for the current year. Again, it also took care of the total accumulated depreciation to get the closing net book value, to take in the statement of financial position. This is what we normally do. But now, when we are looking at the movement in the PPE schedule, especially following up on the capital expenditure, our interest is on cost. So you see the net book value I'm getting here, it will not be the same as the closing net book value. So for 2025, if you are to prepare a statement of financial position for 2025, of course you are going to prepare it. You are going to see that we are going to take the opening value. Then, because our opening value here has already taken care of the first year's depreciation, you remember this? I picked on my net book value to bring this value here. But if you go with this format of trial balance, I could have picked the cost. You see the cost of 15 million, that was the total cost if it was a trial balance. Then I would deduct total accumulated depreciation, which could have been depreciation of the previous year plus the depreciation of the current year to get the closing net book value. Of course, we should get the same figures, and I want to test the two. So let me just finish this. I want to test the two. I want to get my closing net book value here by using alt equals, and then it is for the two. Now, you see this net book value that is closing 2025. I want us to, we will confirm it if we use this approach of trial balance to see if we will get the same closing net book value. In this case, I've just picked on this one and subtracted this. Have not added accumulated depreciation the same way I did here. It is the same thing. The only thing is the figure that I've opened 2025 with is a net book value already. It has taken care of this. If I started from 15 million, I will have to add the depreciation for the first year. Now, how do we get the accumulated depreciation for 2025? Yes? Now, to get the accumulated depreciation of 2025, we will add the depreciation charge or the accumulated for 2024 to the current year's depreciation. So what do I do? I will go and pick on the accumulated depreciation for year one, which is the same as the charge for the year. There was no any other previous one. Then, onto it, of course, I'm going to add the depreciation charge for the current year, this one here. Remember, if I put a positive where there is a negative, my answer will still be negative. Remember, my answer will still be negative. So if I put an equal sign, you see, this is the total accumulated depreciation for the year 2025. Now, let us confirm if our closing net book value is correct. But before we do that, let me just fill in the cost first. I told you that the cost is just the total of the two. So because I had set that formula, let me just drag. Now, I want us to get to understand the impact and the difference between the example I gave and how to apply it here. Now, assume you are given a trial balance again in this our case. In our trial balance, the cost is 15 million. depreciation charge for the year. In this, my example, I gave you a 10%. But in this case, I'm assuming we already computed it. And now the depreciation is here given as 3750. And for year 2, it's given as this. So how do we get the closing net book value? So for you to get the closing net book value, to take to the statement of financial position at the end of the year 2025, at the end of the year 2025, what do? I want us to confirm this figure if it is correct. Borrowing on this concept, what we could have done is we pick the cost the same way I picked on this cost here. What is the cost? The cost is 15 million. I'm picking the cost. Members, I hope we are together. Then from it, I will deduct the depreciation charge for the year, or I will start with accumulated. Let me start with accumulated depreciation. So what is the total accumulated depreciation? That is opening year 2025. It is how much? Sini 3750. This one for in 2024. This is now the accumulated depreciation that is opening the current year. Meaning the asset until 2025, the asset has already lost 3750 before we consider the charge for this current year. So I will deduct 3750. 3750,000. This is the accumulated depreciation equivalent to my 30,000 in this example. Once I deduct the 3750,000, that is the accumulated depreciation that has opened the current year, equivalent to this. Then now I will consider deducting the charge for the year. How much depreciation are we charging for the current year? And it is how much? Already it is here. We completed it. 2812. So I'm just typing 2812, 500. I could refer to the cells, but I'm typing it in because I know someone might get confused of these signs, the negatives and the positives. So I'm just showing you how to deduct it to borrow on this concept here. So once I reduce the accumulated depreciation and I also deducted the depreciation charge for the year, I should get the closing net book value for the year 2025. And I put an equal sign, and I want you to confirm to me that this net book value is the same as this closing net book value. I don't know whether somebody understands what I'm doing here. Members, are we together? I just want you not to get confused. The concept I'm explaining is the same thing. The only thing is that in this case, the format is a bit different, but it is the same. Are we together? Now, this is the closing net book value, which if we were preparing the statement, that's what could appear in our statement of financial position. The arrangement is different, but the concept is the same. Are we together, members? Good, good, good. I'm happy if we are together. That's very good. So that is the essence. I've just reversed the arrangement of the computations, but the concept is remaining the same. Right, so we've confirmed that if we go with the usual approach, we are getting the same figure. And you see, that is the net book value here. Yes. So now, after understanding that, I want us to proceed to 2026. Now, it is now very easy after you have this concept at your hand. So allow me to remove this example that I gave. I'm removing it because now we don't need it. So in 2026, remember, I'm bringing down the closing net book value for the year 2025. Net book value. I'm not bringing down the cost. Remember that very well. So I put an equal sign and pick the closing net book value for the previous year. I bring it on board like that. Then I charge the current year's depreciation. Note 7 told us that it is 25% and it is constant for all the years. So you see the 25% I charged here, it is the same. So what do? I don't want to repeat myself all the years. So because it is the same 25% and it is referring to the cell where we have the balance brought down, and I'm not locking the cell referring to the balance brought down because I want to drag it to the end. This computation will remain the same to the end of the year. This one is dash because we still don't have a figure brought down here. This one is also dash because we still don't have a figure. But because we are picking the balance brought down, the net book value of the previous year, the same way I referred this here. And you can see also in 2025, I referred to this. Now that pattern, Excel has already mastered it, that I'm referring to the cell that is below in the previous year. I can still drag that formula and it will go to the end, you can confirm that it will refer to this cell where I should have my net book value. This one also will refer to the cell where I should have it. So eventually it will autofill when we give those figures. Now, if I put, because already we have the depreciation charge for the year, net book value opening, we will get a closing net book value. Once we have a figure here, you will see 2027 will have a figure, and eventually it will compute the depreciation because I've set a formula here already. It will just do it on its own. So what do? This, because already also we had a formula. To get the net book value, it is the auto sum of these two. I will just also drag the formula to the end. You will see these ones getting auto-populated on their own. The concept being followed is the same, the one that we did in 2025. That's why I took time here to get you understand, because these others will follow the same concept. I hope somebody is not confused. That is my prayer. Now, you see this accumulated depreciation. I hope somebody understood how we get accumulated depreciation. Depreciation of the previous year plus the depreciation of the current year. We are getting the total amount by which the asset has lost value. And remember, depreciation is increasing every year because the asset is reducing in value every year. And as it reduces in value every year, our accumulated depreciation account keeps growing. It keeps growing. So you see, in year one, it was only 3750. When we came to year two, it is now 6562. Why? Because we are adding the one of the previous year to what we are charging in the current year to get the total amount by which the asset has lost value. As we move to 2026, that value of accumulated depreciation is also going to grow. Why? Because in 2026, the asset has also lost some value. So we are going to add this to this to get the value at which the asset has totally lost up to that date. Because there is a pattern that I had set here. Now, there will be no harm. I can even refer to the cell individually again, or there is no harm if I drag. If I drag like that, you will realize that now our accumulated depreciation for 2026 is now 8 million. Because there is that depreciation that has added. The asset is continuously losing value every year. When we come to 2027, there is also another charge for the year there of 1,500,000, meaning the asset is continuing to lose value. That's why the net book value has a trend of reducing trend. You can see it was 11 million, it came to 8 million, 6 million, 4 million, and eventually 3.5. It is reducing in value. Why? Because of depreciation. And I want you to also confirm something. I just want to drag my formula to the end for accumulated depreciation, and you will see. You see the total accumulated depreciation at the end of 2028. You see that value? It is 11,440,000. This total accumulated depreciation is the same as the total depreciation figures for all the years. So even if I highlight the depreciations from year one to the end, you want to confirm to me, are you seeing this figure down here? Look at this place. Is it not the same as the total accumulated? The 11,440,000. You see, it is the same. It is just the total depreciations for every year. As the asset is being used, it is reducing in value. So you'll see it is the same figure here. And you can still do all this. You see all this we've done here. You can do them in one cell. Yes, you can do them in one cell. If you're given accumulated depreciation, you deduct from cost, you get the closing net book value. I mean, it's very easy. You just get the 15 million, which was the cost of the asset. The cost remains the same. If I deduct the total accumulated, I should get this closing net book value here. You see the 3.5 million, I should get it. And of course, that is the figure I'm getting. You see, it is the same figure which is here. This figure and this figure are the same. So the concept remains the same. Approach may be different, but the concept, that's why I normally insist on concept. Just understand the concept. Whichever way the question comes, you will understand it. So in that case, our interest was not the net book value. Of course, let me tell you, you see this net book value that we have, we are going to use them in the statement of financial position because it is the required Roman what? Roman 2. So these figures, we are going to pick them and take them to the statement of financial position. Yes, these figures here. And I hope now you understand how they come. We're going to use them. But in our case here in note 7, we are looking at the capital expenditure, the CapEx. the movement in the capex. So because of that, and remember, the impact of the depreciation and accumulated depreciations, the movements, and the changes in the net book values, they go hand in hand. And as we check on the movement in cost, I told you that the cost of the asset takes care of the depreciation and the accumulated depreciation, both together on the cost. Now, we are in year number 2025, and I want you to understand something. Now, in year 2025, we opened it with the net book value closing year 1. So, to get the cost of the asset in year 2025, we pick the net book value that has opened the year, that is the 11,250. Then we add the total accumulated depreciation for that year. We add, but because my accumulated depreciation is in negative, to add, if I put a negative, a negative and a negative will be positive. So in essence, I'm adding this because of this negative and the negative. Or you can just opt to type it in, referring to this cell, and then you add 65, 62, 500. Now, this will give us the cost of the asset in 2025. We are checking on the capex, the changes in the cost of the asset. In essence, when you are doing the cash flow statement, you would be asked, was there a purchase or a sale of an asset? How do we check the purchase of an asset? We normally check on the trial balances given, on the values given for 2020. For example, in the cash flow statement, you are given, for example, statement for 2020, then you have a statement for 2021. Members, I just want somebody to understand how the capex come in. In the usual statement, unapewa hivi in the trial balance. Then I'm assuming in the trial balance, in the first year, you are given, in 2020, you are given 15 million. So 2020 is the same as our 2024 in this our question. Then 2021, you are given, this is the cost, like that. So how do you know if there was a purchase of an asset? That is an outflow. You will say that this company, they purchased an asset because in 2020 it was 15 million. In 2021, the value now is 17. So what must have happened? They must have purchased the asset. By how much? They must have purchased it by the difference. And that gives you that value of 2812. So this is in cash flow statement. This is the comparison that we normally did to check on the movement in the PPE schedule, the movement in the values. Now, this is the case again here. So I'm comparing and telling you that the cost of the asset in 2025 is now 17,812. It is the same concept here. It's only that in 2024, I picked the net book value and added the accumulated depreciation. Again, when I come to 2025, I'm also picking the same net book value, but at a different position. I did not pick this net book value here. Yes, because I'm picking on the accumulated depreciation, which already takes care of this my depreciation charge for the year. So it is the same thing I'm doing. Once I set that formula, I will just drag to the end. And I have my costs up to the end. So we can check on the changes in the cost to get the capital expenditure per year, capital expenditures per year, like that. And that is the information we need to use in our modeling of this statement of profit or loss. Wow. That part, once you understand it, you will not have any problem. You will not have any problem. Do you know what we've done? What we've done here, we will use this information in our cash flow statement. We will use this information in our cash flow statement, and we will use the same information in our statement of financial position. So this working alone, this working we've done here is going to help us in all the 3 questions that the examiner is asking. That's why it is a very, very vital working that you need to remember. This working here is very vital. And in fact, this is one of the areas the examiner was testing. Will you be able to do this? Because if you do it wrongly, your statement will be wrong. You will not get the full marks. You might score up to this point, but from here, everything will be wrong if you get it wrong here. So that's why it is very vital. Your statement of financial position will be wrong if you get it wrong here. Your cash flow statement will be wrong if you get it wrong here. So members, this section, I know I've taken time in this part, but it is vital. It is vital because it will affect all this. You will fail across the board because they're all connected to this. So what did we want to compute here? Our interest was depreciation. Jaden is asking that we pardon on that part or cost. Yes, Liaka, it is very time consuming, but I want to ask you, Siaka and maybe the rest who maybe have, are seeing that this part of PPE schedule is taking quite some time. But let me ask you, what other way? Do you have another option to get these full marks if you don't go through this thing, the PPE? My answer is no, you don't have. Do you know why? Because we need that depreciation charge for the year here. And of course, if it is wrong, your statement, you might get the depreciation charge for the year and avoid all this headache of Mara accumulated, Mara cost. You see this? You can assume this too. And if you assume those two lines here, remember your cash flow statement will not be complete. You will lose these marks. You might get just a few of the 6. So you don't want to lose these marks. So make sure you understand. Now, for Siaka, was it Siaka or somebody? Liaka, sorry. For Liaka, I don't know whether I'm pronouncing the name correctly, but if I'm not pronouncing correctly, you'll pardon me. I'm just reading it the way it is. So literally the way it is, literally. It might not be very correct. Your name might sound a bit, not the way you like. So I seek for your pardon in advance. Now, the concept behind the cost here is very simple. I want you to relate. And I can still relate it to the example that I gave. Now, how do you normally compute the net book value? Just relate it from here and you'll understand how cost is coming here. Now, net book value, you normally take the cost, which of course you are normally given the cost in the trial balance. Then you deduct accumulated depreciation, any depreciation that has accumulated from the previous. Mark my words, I'm talking about previous periods. Because when getting net book value must be for a specific year. It must be for a specific year. Mark my, this net book value, it is not just a word like that. It is for a particular year. When computing that net book value for a particular year, you will take the cost of the asset. Of course, cost is the amount at which the asset was purchased initially. Then you deduct any depreciation that has accumulated from the previous period up to the current year. The previous period, because the asset has been in use. So it has been losing value over time. So add that accumulated depreciation to the start of this current year. Then you also deduct the depreciation charge that you are charging for the current year. Depreciation charge for current year. That will give you the closing net book value. This will give you the closing net book value for this year. Yes? So in this our case, I want you to relate in this our case. Our net book value for 2024. What did we do? We took the cost of the asset, which was 15 million. That is what we were given. We did not have any accumulated depreciation from the previous years. Why? We are modeling the statement from today. So we don't have any, the asset has not lost any value before. The asset is still at the same value. So that's why accumulated depreciation is 0. Then we are deducting what we have charged as depreciation for this current year. How much is it? This figure, 3750,000. 3750,000. That gave us the net book value for the current year, like that. Yes? Now, from this net book value, if I wanted to get the cost of this asset for the current year, if I have this, what will I do? I will just reverse this. Make cost the subject of that formula. Make cost the subject. If you want to get the cost, what you do is very simple. Bring cost as the subject of the formula, meaning you see this accumulated depreciation, it will cross the equal sign and it will become a positive. So you will add accumulated depreciation. Then again, you see this depreciation charge for the year, it will cross this sign and it will become a positive. You are adding depreciation charge for the year. Like that. So this is the concept. It is the same formula, netbook, how to compute net book value. And then, after I've brought this accumulated depreciation on this end, becomes a positive, this depreciation becomes a positive, this net book value will again cross this end, and because it was positive, now it will become a negative. Yes, it will become a negative. So members, I hope you see the concept on how we got this cost. Added accumulated to the net book value. So my net book value, did I see some chart? No. So the reason why I just want to leave this formula at this point is because somebody might get more confused. But pick it from the net book value computation. And if I activate this formula, of course you can see. I'm adding net book value to the accumulated depreciation. So let us check. What were we looking for in our statement of profit or loss? What we are looking for is very simple. We were just looking for depreciation. We have done a lot of computations which we will use for the others, but in this case, we only needed depreciation. So what do we do with the depreciation? We already have it. It is a negative because it is an expense. Let me see. From our computation, you can see they were all, computed. So I just refer to that one cell. Then after that, I drag to the end. I have all my depreciations to 2028 like that. So I've knocked out depreciation. So what is remaining? Earnings before interest and tax. So EBIT is what is remaining. So the D is knocked out. The D is the depreciation. So I'm using Alt equals to get the net effect of these two. And I'm having my earnings before interest and tax. I autofill to the end like that. Then again, what do? I want to knock off this interest because interest is an allowable deduction. We always know that. Interest is an allowable deduction. So we need to deduct it before we compute our tax. So members, how do we get the interest? Let us look at the note that is guiding us on interest. And it is in note 8. What did they say about interest? They said interest rate is a percentage of debt. And is at what rate? It's at 10%. So in that case, do we have the value of the debt? Do we have the value of the debt? Let's see. Where do we have the value of the debt? The debt is given, I'm seeing some chart here. Mawia is saying, do we less interest before tax or after computing tax? All right,
Excuse me,
Mawia.
sir.
Yes.
At that part of depreciation, we've taken it directly from the PPE schedule. But
Yes.
in information number 7, we are told that the percentage is 25%. Why did we pick it as a whole figure?
All right, thank you, admin. We were told, I agree, in note 7, we were told depreciation is at 25%. How did we compute the depreciations in our PPE schedule? I will activate my formula, and of course, you see, we used the same 25% that we were told in note 7. So this is the same 25% we used on the value of the PPE. It is the same 25%. So there is no difference. You can still go ahead and compute that depreciation directly on this cell. But I did not do that because we already have it. So why do I do what we already have? That's why I just referred to it, and it is the same 25% given. So for admin, I hope that's okay. Is it okay, admin? All right, all
Yes.
right, all right. Alex is telling us that the debt is in note 13 and Win is supporting the same by giving us the value. That debt is 5 million. Thank you. So if that is the case, if the debt is 5 million, why do we need to worry so much? What we do, We could. And by the way, members, I have always insisted to save on time in an exam room. Once you have an idea on the entries to make, maximize on entries. Remember, we are required to prepare statement of financial position, right? For the 5-year period. So, because already, remember, we've done PPE schedule here. The figures we've gotten, we're going to use them in the statement of financial position. This data that we've been given in note 13 is also part of the statement of financial position. So you can either draw the financial statement of financial position and start feeding the figures, or we could as well just still do, the interest computation per cell. So for now, because we've not drawn the statement of financial position, let's just do the interest, or we can call it finance cost. So let me just call it interest, the way they've named it. It's because someone might say, why do you call it finance cost yet it was interest? All right. So under this case, it is still the same 5 million. So they told us it is 10%, right? Was it 10%? Just to be sure. Yes, it is 10%. Interest rate is percentage of debt at 10%. So what is our debt? Note 13 is telling us debt is 5 million. So because I did not write any 5 million in a cell, if I could have drawn the statement of financial position, I could refer. But here, let me just type 5 million like that. And we have our debt. And because it is an expense, we are deducting it. Let me bring it in as a negative like that. So it is 500. It is 500,000. And that is remaining constant across the years like that. So it is the same 500,000. We've knocked out the interest. We come to earnings before tax now. There was a member who was asking, do we deduct the interest before or after? You deduct interest before you charge tax. Remember that interest on loan or on debt, interest is an allowable expense. What do we mean by allowable? Tax is not charged on that. It is a relief. It is allowable. That's why we deduct it as an expense before we charge our tax. So we come here and get the net effect of the two. So EBIT minus the interest value, we get our earnings before tax. Then now we can go ahead and charge tax like that. So I want to put this in bold because it is a profit element. So we have that. Then now from there, we charge our tax expense. Of course, we were given how to charge the tax expense. I see it's already 7. So let me just charge the tax very fast and we close, we end. So we were told in note number 9, the applicable tax rate is 30%. That is very direct. So equal sign 30%. We multiply by the earnings before tax like that. And because it's an expense, I want to put a negative like that. I'm getting my tax expense. Then, of course, after that, I'm having my profit after tax. I've already charged my tax, so I'm getting my part, profit after tax. So, alt equals earnings before tax. I take away tax. I autofill to the end. I have profit after tax. Let me see. Somebody was saying, activate the cost formula for year 25. Oh, Eileen, you wanted me to activate the cost formula. Here it is, Eileen. I hope you are seeing it. It is the balance brought down of the net book value from the previous year. Then I added the accumulated depreciation to get the cost. That is it. So here, profit after tax. I was seeing some charts here. Let me see. The formula for cost. Okay, before I go to cost, I want to finish this section of statement of profit or loss here. So I have the profit after tax here, which I think now is the end of it because this is the earnings for the year. We normally transfer to the statement of changes in equity. But before we do that, I want to see any other note that we've not captured here, anything affecting statement of profit or loss. I think there is none. But I want you to remember very well that in the statement of changes in equity, of course, we are not asked to prepare it here. We are not going to prepare it, but you need to know what profit do we normally transfer to the statement of financial position. To the statement of financial position. We normally transfer the profit for the year to the statement of changes in equity. We subject it to any other changes. If we have profit brought downs, we have dividends, we have everything that affects equity, then we get the final figures to take to the statement of financial position. Here, we are not preparing statement of changes in equity, but I want you to remember at the end, at the back of your mind, that because we have a range of years, these years must be, as you move from one year to the next, there is that profit that is carried forward, and it will affect what is coming to the next year in terms of retained earnings. So when you come to year 2025, you must have retained earnings brought down. 2026, retained earnings brought down and carried down, brought down, carried down, brought down, carried down. And allow me to end the session there. We finish the remaining section tomorrow. Members, this week, it is my wish that we even, if you are free on Wednesday, I would want us to use it to cover some of these contents because time is running out. And the more sessions we get, the better. The more sessions we get, the better. So I would ask us